CNBC-TV18.
It's the year Russia invaded Ukraine and rattled the world. It's the year Argentina made history by lifting the Football World Cup. It's the year thousands took to the streets to protest Iran's morality police. It's also the year that nearly broke the back of cryptocurrencies. It's the year Finfluencer and Fitspiration made it to mainstream English. It's the year China tightened and then eased its harsh COVID restrictions. It's the year Japan's Abe Shinzo fell to an assassination attempt and Pakistan's Imran Khan survived one. It's the year inflation rose around the world, prompting central banks to go on a rate hiking spree. It's also a year a lot of the world limped back to normalcy after 2 years of lockdowns. As 2022 winds down, let's take a look at some of the seminal moments it has given India's economic and financial history. I'm Shireen Bhan and this is Rewind 2022. For many, the 2 years of the pandemic forced restrictions meant pain, but one sector thrived, the Indian IT industry. Orders were up, dependence of tech support increased, and profits were higher. So was hiring, often leading to bloated teams and benches. All of this changed dramatically in 2022 as the recovery exposed gaps in the IT boom. When the dust settled, rate hikes to curb runaway inflation sparked fears of a recession in many parts of the world. And so the strings holding India's IT story together started showing signs of fraying. Across the globe, tech giants lost trillions of dollars in market cap as the big tech sell-off accentuated, and shell-shocked companies started laying off thousands of employees across the board. Some of the smaller players have even ceased to exist. CNBC-TV18's Rima Tendulkar recaps the brutal year that 2022 has been for the tech sector.
It's been a brutal year for tech giants around the world. Apple stock is down about 18% so far, and it is one of the better performers. Facebook owner Meta, Amazon, Netflix, Google's parent company Alphabet have all fared far worse, with Meta plunging nearly 65% this year. The other tech giants of Nasdaq, chip giant Nvidia, Elon Musk's Tesla are also down massively so far in 2022. What's hurting? Rising interest rates, macroeconomic uncertainty and global pressures. Recession worries are hurting Amazon and Apple, and concerns about a strategy shift. For example, Meta going all in on augmented and virtual reality, Netflix embracing advertising for the first time ever is also hurting. Let's talk about what happened back home in India. Now, 2022 has marked a sharp decline in stock prices of Indian IT giants as they moved in step with their global counterparts. As things currently stand, this year could be the worst year for Nifty IT since 2008, when the index was down close to 55%. The reason? PED rating, as global interest rates went up, and then there were some EPS cuts as growth forecasts moderated. TCS is now trading at a forward multiple of 25-26 times. The peak was 32 times, and the list goes on, with Infy, HCL all trading at a much lower valuations compared to their peak. The worry is also about what next year holds. Analysts estimate that growth will slow down further. Nomura is saying the US dollar revenue growth to slow down to 8% next year versus 12.7% in FY23 for the big companies. The next big story of 2022 were the tech layoffs. Now, according to a layoff tracking website, layoffs.fyi, data as of mid-December shows nearly 1,000 tech companies have laid off close to 1.5 lakh employees. And that includes biggies like Meta, Google, Amazon. They've laid off thousands of employees. And the question is, will this belt tightening continue next year? And the answer is probably yes. Many companies which have not announced their job cuts yet are likely to do so next year. HP is looking to pull back on its workforce. Reports suggest Google is looking to axe about 10,000 employees next year. And here we're only talking about the multinational tech giants. There are so many smaller startup companies where we are seeing some big job cuts too. But the biggest newsmaker of the year for me is Apple, which moved its iPhone 14 production to India. Now, Apple has been assembling smartphones in India since 2017. But up until this year, Apple used the manufacturing facilities in India to assemble the older generation handsets, the legacy models. This year, 2022, was the first time Apple produced the latest smartphones. They produced the phones as the same year as its release, just a few months of lag compared to China. And the story is we've just gotten started. According to JP Morgan, every fourth iPhone will be made in India by 2025. What's the driver of this big shift? China unrest, reduce your dependency on China, and an affirmation of India's PLI scheme. According to India Cellular and Electronics Association, India is likely to export handsets worth $9 billion in FY23 versus $5.8 billion in FY22, a whopping jump of 55%. And this is the big question as we step into 2023. Can India become the new smartphone manufacturing factory for the world?
Euphoria, scandal, meltdown, contagion, bankruptcy, manhunts, arrests. If it's drama you were looking for, the cryptocurrency ecosystem had it all. When it began, 2022 was seen by many as another year for the crypto asset story to stamp its dominance as an asset class of the future. Many companies and major banks, even a government or two, started putting their might and their money behind these blockchain assets. But as the macro situation took a turn for the worse and financial markets stumbled on the tremors of uncertainty, the house of cards has come crashing. Frauds were unearthed, exchanges and funds closed down, regulations become stickier, and the entire business model has come unstuck, leaving investors and their virtual millions staring at real ruin. 2022 became the year that broke crypto's back. Manisha Gupta recounts.
The year 2022 witnessed the crypto winter loaded with sell-offs, scandals, layoffs and unfavorable macros and markets. The shutdowns, rug pulls and the contagions that followed made matters further difficult. The market is full of debt due to rise of centralized lending schemes. 2020 onwards saw a huge build-out in retail, yield-based DeFi, crypto shadow banking and unsecured or under-collateralized lending. The pain started with a sustained sell-off in cryptos. For the current year, the prices have declined sharply, down by 60% for Bitcoin, Ethereum is down 64%, decentralized Mana is negative 88%, and meme coins Doge and Shiba Inu down 47 to 72%. The total crypto market capital hit peak at their $3 trillion, which has now come crashing down to below $1 trillion, a more than 70% of decline. The sell-off was accentuated by collapse of algorithmic stablecoin Terra USD. It was clear from the events that followed that the credit risks and counterparty risks were not assessed with vigilance. Down went the Celsius network, once valued at $20 billion. Same happened with Three Arrow Capital. Equinox, which was listed on Nasdaq, also shut shop. The other names like Wald, Voyager Digital met with the same fate. And towards the end of the year, the once valued at $32 billion FTX crypto exchange filed for bankruptcy, followed by BlockFi and Bitfront in Singapore. The other market, which is NFTs, and that was quite a rage and became a mainstream phenomenon in 2021, also saw a meltdown in 2022 with volumes crashing nearly 70%. And then there is more, and this is from miners who, due to fall in crypto prices, have not paid electricity bills, leading them to sell their holdings. The total cryptocurrencies as of now stand at more than 10,000 in number, and in last 10 years, nearly 2,421 cryptos have failed. When markets started to fall, funds, lenders, others were forced to sell, leading to a domino effect. Street believes that 2022 may be drawing to an end, but the crypto winter could last another 6 to 8 months.
For the sector the RBI regulates, the year has brought with it a near paradigm shift in fundamentals. The pain from non-performing assets has died down to almost a dull throb, and it is now a season of healthy loan growth and profitability. Abhishek Kothari balances the books of 2022 for the Indian banking sector.
Well, 2022 has been a phenomenal year for the banking sector. Bankers have a reason to smile as they move away from the pain of NPA cycle to healthy loan growth and profitability. So talking about profitability, Profits for the sector on a quarterly basis has increased from rupees 36,854 crores in Q2 FY22 to right now about 58,717 crore as of Q2 FY23. Now, factors that have helped in improving the profitability of the banks is improvement in loan growth and reduction in stress portfolio of the banks. So, loan growth for the banking sector as of Q2 FY23 was at 16.44%, perhaps one of the highest that you saw from 1st of November 2013. The rise in loan growth helped in stronger top-line growth for the banking sector, which has helped the bottom line or the earnings of the banks. So the loan growth incrementally has been driven by the retail segment. Now corporates have started to come back for working capital loans as money market rates have shot up through the roof. So capex-based demand going ahead may augur well for healthy loan growth rate for the banking sector. Stronger loan growth has also translated into healthy operating profit growth for the banking sector. Operating profits of the sector has grown from 97,383 crore in Q2 FY22 to right now a little under 1,15,000 crore as of Q2 FY23. Stress reduction. The banking sector has seen its gross NPA ratio decline from 7.4% in Q2 FY22 to right now about 5.24% in Q2 FY23. In value wise, the decline has been 15.2% YOY in Q2 FY23. The declining gross NPA amount wise has largely been led by the PSU banks. Now PSU banks gross NPA on a value wise has declined by 15.9% YOY, that is from Q2 FY22 to Q2 FY23, while that of private sector banks has declined by 12.7% in the same period. So PSU banks, the gross NPA ratio has declined by 256 basis points from Q2 FY22 to Q2 FY23, while that of private sector banks has declined by 119 basis points in the same period. Banks' balance sheet has strengthened with their core provision coverage ratio increasing from 69.7% in Q2 FY22 to right now about 74.6% in Q2 FY23. PSU Bank's core provision coverage ratio has increased to 74.9% in Q2 FY23 when compared to a little under 70% in Q2 FY22, and that of private sector banks has increased to 74.4% in Q2 FY23 versus 69% that they had a year ago. So for 2023, the loan growth could remain strong and could be in double digits. Net interest margin will continue to expand till Q4 FY23 results as loans are getting repriced faster and at a healthier rate. Return ratios will expand as credit costs will come down and stress in the balance sheet will continue its downward trajectory.
For the most part, 2022 has been the year Indian drug makers felt the shivers that come when a fever breaks. What does it look forward to in 2023? Find out after this short break. Welcome back to Rewind 2022. With the shockwaves of the COVID-19 pandemic fading or at least taking a backseat and the world's eagerness to a return to normalcy, the frantic dependence on healthcare has started to wane. Testing requirements fell, the large number of the population being protected through multiple inoculations, the frenetic rush to stock up on drugs also evaporated. Recovery levels rose, the world opened up, and all of this meant the diagnostic chains, healthcare centers, hospitals, drug makers and pharmacies saw their growth engines return back to normal. Back home, barring a few companies like Sun Pharma and Cipla, most pharma players have underperformed the frontline indices. Ekta Batra fills out an after-action report on the highs and lows for the Indian Medicare space in 2022.
2022 saw opportunities from COVID-19 dwindling. Case in points were the likes of Serum stopping manufacturing of its AstraZeneca vaccine, Zydus and Dr. Reddy's COVID-19 vaccine sales not really taking off, Wockhart's UK sales falling as supplies to the UK government dipped, and lastly, Divi's Lab seeing dwindling intermediate supply opportunities for Merck's COVID-19 drug Molnupiravir. For the US, an important development was a clutch of Indian companies such as Natco, Dr. Reddy's, Cipla launching the generic version of the blockbuster cancer drug Revlimid generic. Challenges included fierce price pressure in the US continuing with the likes of Lupin exiting certain drugs and Aurobindo delaying its injectable sales guidance of $650 to $700 million to FY25. It was also a patchy year for the US FTA inspections, with problems continuing for the likes of Sun's Halol facility, Cipla's Goa plant, Glenmark's Badi plant. Price pressure, delayed launches in the US, supply challenges along with inflation weighed on most companies' margins in FY23. Gland and Divi saw margins sharply fall in the first half. Aurobindo reported margins at a multi-quarter low of 13.7% in Q2, and while Lupin did see a recovery in margins in Q2, it disappointed with margins hitting lows of 7% at some point in the year. 2022 was also a year of acquisitions in India as companies scouted for growth. We saw companies either buying one or a portfolio of brands such as Dr. Reddy's and JB Chemicals, buying cardio drugs from Novartis, or Mankind scooping up Panacea's domestic brands. Not in the domestic market, but this year was also marked with the $3 billion buyout of global company Viatris's biosimilar business by Biocon. So what is the way forward in 2023? The ability to withstand price pressure in the US, which would be fueled by key drug launches in the US, such as Lupin's inhaler drug Spiriva generic, Cipla's cancer drug Abrixon generic, or Biocon's biosimilars insulin aspart and bevacizumab, and continued sales for Sun Pharma's specialty business. 2023 will also be marked by companies undertaking remediation to solve outstanding US FTA issues and taking steps to fuel growth in other markets such as India and even China. Let's leave you with valuations of the companies on an FY24 basis, what they started 2022 with, and where they are ending the year.
Sonal Bhutra turns back the clock for a review of the real estate sector's year and explores possible risks that 2023 may throw up.
"2022 was about a lot of things. An uptick in real estate cycle is definitely something worth highlighting. We are talking about a steep uptick in residential demand and sales. So let's look at some numbers now. Absorption in residential real estate is not 1, 2 or 3-year high, but at a decadal high. Absorption in residential real estate is basically the amount of space or units which are occupied within a market over a given period of time, typically 1 year. In calendar year 2022, so far, it is at 447 million square feet, which compares with 400 to 425 million square feet that we have seen in past couple of years. It even dipped to 281 in 2017 when the cycle was undergoing some decline. While absorption is increasing, inventories have been declining. Unsold inventory was a big pain point for developers as supply was exceeding demand. But now trends are seeing a reversal. Ready-to-move-in inventory is declining. From levels of 849 billion in 2019, it is now around 500 billion, and that is a big decline. That is for ready-to-move-in inventory, which was still more resilient than under construction. So if we look at the under construction segment, that has declined from calendar year 19 to calendar year 2022. Calendar year 2019, remember, saw a massive increase in inventories. So barring Hyderabad, in the top cities, there is a decline. 23% for Mumbai, 29% for Bengaluru, 14% for Chennai, 20% for Gurugram, 4% for Delhi, 34% for Pune. Only Hyderabad saw an increase of 145% in inventories. Decline in inventories was accompanied by increase in prices. We have been speaking to a whole host of developers, and they have been of the view that passing on price hikes in the last quarter was not very difficult. So price hikes in the September quarter in some geographies have been massive. 3 to 4% in Mumbai, 14% quarter-on-quarter for Delhi NCR, 30% YOY there. Hyderabad has seen a 10% price increase. Navi Mumbai at 14% YOY, up 8% sequentially, and Chennai has seen a decline sequentially, but an increase on a YOY basis. Bengaluru and Pune have also seen moderate price hikes. This is across the industry, including organized and unorganized players. But some experts are of the view that maybe it will not be easy to pass on price hikes now, considering the massive hike in interest rates as well as the inflation. If we look at how listed players have done, strong first half of FY23, more than 100% growth in some cases. Prestige, Macrotech, Mahindra Life Spaces saw more than 100% growth. We have Godrej Properties and DLF with more than 60% growth in bookings, Oberoi at 92%, the likes of Sobha, Kolte Patil, Brigade and Sunteck between 20 to 50%. So, What could the risk to this massive rally be? Definitely rising interest rates. RBI has hiked rates to 6.25% in last few policy meets. And we did ask some big real estate names, and DLF told us that demand for real estate sector was impacted when mortgage rates were at 9%, while Prestige Estates told us if mortgage rates cross 9%, it will impact real estate demand. So rate action from the RBI will be key to watch. Ending this data with some news we got some time back. This is related to commercial real estate, but only goes on to show the impact of rising rates. Blackstone and Starwood Funds Limited saw withdrawals from their real estate funds, and this was following surge of redemption requests. Big and small investors were queuing up to pull money out of real estate funds, which is a sign that yes, the surge in interest rates is threatening to impact at least the commercial property sector. These are two isolated cases, but whether it starts to have an impact on the entire sector, we'll wait and watch.
Over $100 billion worth of deals have been signed in the year. Even the startup space has seen a fair share of funding coming in, though the funding winter has put a chill into the proceedings. Nisha Poddar runs through the big M&A deals and trends of 2022.
The year 2022, as it comes to an end, has clocked in deals worth $118 billion so far, majority of which came in from the mergers and acquisition space, while private equity also participated with $33 billion. Now, in terms of the sector breakup, well, top 5 in M&A came in from first the banks and financial services topping the chart, followed by other sectors like manufacturing, IT, renewable energy, as well as logistics. Now, the private equity investments were highest in the e-commerce space in the year, followed by other sectors like media. We saw a lot of interest, infrastructure, energy, as well as the financial services. Let's also take you through the top 5 deals of the year. HDFC and HDFC Bank's mega merger clearly is the largest, boosting the overall deal value for the year. And the second one is Holcim Cement Assets, Ambuja, as well as ACC, and that was the most hotly contested battle amongst various conglomerates, won finally by the Adani Group. Now, Biocon's acquisition of Viatris's biosimilars business is also path-breaking in the context of an overseas acquisition done by an Indian company. Fourth on our list is the global steel giant ArcelorMittal's acquisition of SR Group's ports as well as power assets, critical to its steel assets, which, remember, marks the full and final completion of the SR Steel's buyout via the IBC process, which, remember, has been a very long-drawn deal. So that comes to an end now. And last is the Yes Bank equity deal by private equity firms Carlyle as well as Advent, which, remember, is an important milestone in Yes Bank's bailout plan. Now for the year ahead. Most deal makers are cautiously optimistic about the deal activity, and consolidation could be a big theme play out as economic pressures weigh on the weaker companies. Now, the startup funding winter is already here and expected to intensify further. With the valuations volatile, well, deal closure could be a challenge, while private equity braces up for some value buying in the next year.
Well, the funding winter in the startup space may take a while to thaw out, but the bigger question is whether this chill will spread and result in more cases of frostbite. Answers to those questions as 2023 unwinds, but till those answers come in, here's wishing all of our viewers a very happy New Year.